December 15th, 2025. A date that might go down in financial history. While most people were focused on holiday shopping and year-end planning, something extraordinary was happening in the precious metals market. JPMorgan Chase, America's largest bank by assets, quietly executed what industry insiders are calling the most strategic precious metals accumulation in modern banking history. Here's what caught my attention. Over the past 14 years, this financial giant has methodically built what could be the most significant silver position ever assembled by a single institution. We're talking about numbers that should make every investor pause and reconsider everything they thought they knew about this overlooked metal. But this isn't just about one bank buying silver. This is about recognizing a pattern that's played out through centuries of financial upheaval, a pattern that transforms ordinary assets into extraordinary wealth generators. And right now, based on the data I've been analyzing, we might be witnessing the final stages of this pattern unfolding in real time. I'm not here to give financial advice. I'm not affiliated with any institution mentioned today. What I'm sharing is educational analysis based on publicly available information that anyone can verify. But if you understand what I'm about to reveal, you'll see why some of the smartest money in the world has been positioning for what could be the most significant precious metals event of our lifetime. Let me start with a question that's been keeping me awake at night. If silver is just an industrial commodity like so many experts claim, why would the most sophisticated financial institution in America spend over a decade accumulating massive quantities of it? Why would they dedicate vault space, capital, and resources to something that supposedly doesn't matter? The answer lies in understanding something that most people completely miss. Silver isn't just a metal. It's simultaneously an irreplaceable industrial input and a monetary asset with 5,000 years of trust behind it. When you combine surging industrial demand with monetary uncertainty, you don't get gradual price appreciation. You get explosive moves that reshape entire portfolios overnight. Here's the reality that's been hidden in plain sight. Since 2011, JPMorgan has quietly accumulated what industry sources estimate to be hundreds of millions of ounces of physical silver. To put this in perspective, this represents more silver than many entire countries hold in their strategic reserves. More than legendary investors have ever controlled. More than seemed possible for a single institution to acquire without moving markets dramatically. But they did it intelligently. While other market participants were focused on paper trading and short-term speculation, JPMorgan was building a position that could only be described as generational. They weren't thinking in quarters or fiscal years. They were thinking in decades. The timing of this accumulation tells us everything we need to know about their strategy. It began right after they settled regulatory charges related to precious metals manipulation. Instead of retreating from the silver market, they completely reversed course. They went from being short-term traders to becoming the largest accumulator of physical metal in modern history. What makes this even more intriguing is how they executed this strategy. Rather than making dramatic market moves that would attract attention, they used market volatility to their advantage. Every time silver prices dropped due to economic uncertainty or technical selling, they were there, steadily building their position. Every time industrial users needed to secure supply, JPMorgan had the inventory available. This brings us to the current situation, and why I believe we're approaching a critical inflection point. The fundamentals supporting silver have never been stronger, yet the price still reflects decades-old assumptions about supply and demand. Industrial consumption has exploded due to solar energy expansion, electric vehicle adoption, and advanced electronics manufacturing. Meanwhile, mine production has struggled to keep pace with this surging demand. The mathematics are becoming impossible to ignore. Global silver inventories on major exchanges have declined dramatically over the past few years. Industrial applications now consume the majority of newly mined silver, leaving minimal amounts available for investment demand. Yet paper markets continue to trade silver as if abundant supply will always meet any level of demand. This disconnect between physical reality and financial markets is exactly what JPMorgan appears to have been positioning for. While paper contracts multiply and derivative positions expand, They've been accumulating the actual metal. When the gap between paper promises and physical availability becomes impossible to maintain, those holding real silver will benefit enormously.
Consider what happened during previous periods of monetary uncertainty. When confidence in paper currencies wavered, investors fled to tangible assets. Gold and silver became safe havens, not because of speculation, but because of their intrinsic value and historical reliability. JPMorgan seems to be positioning for a similar scenario, but on a much larger scale. The industrial demand story alone should concern anyone not paying attention to silver. Solar panel installations are growing exponentially worldwide, and each panel requires silver for optimal electrical conductivity. Electric vehicles use significantly more silver than traditional automobiles. Advanced electronics, medical devices, and infrastructure projects all depend on silver's unique properties. Meanwhile, silver mining hasn't expanded to meet this growing demand. Most silver comes as a byproduct of other mining operations, making it difficult to increase production quickly when demand surges. The result is a structural supply deficit that's been building for years, creating the perfect conditions for dramatic price movements when market dynamics shift. JPMorgan's accumulation strategy becomes even more impressive when you consider the broader monetary environment. Central banks worldwide have been expanding money supplies at unprecedented rates. When currency values become questionable, precious metals historically serve as stores of value. Silver, with its dual role as both an industrial necessity and a monetary metal, offers unique advantages in such environments. The bank's timing appears particularly strategic given current market conditions. Interest rates have been volatile, economic uncertainty remains elevated, and geopolitical tensions continue affecting global markets. These are exactly the conditions that historically drive investors toward tangible assets, like precious metals. What makes JPMorgan's position especially powerful is their ability to influence market timing. Unlike individual investors who must react to market conditions, major institutions can help create the conditions that benefit their positions. When they decide the time is right to realize gains on their silver holdings, they have the resources and market knowledge to maximize their returns. The implications extend far beyond one bank's investment strategy. If silver prices surge as dramatically as some analysts predict, it will validate an investment thesis that took over a decade to develop. It will demonstrate the value of patience, strategic thinking, and understanding long-term market cycles rather than chasing short-term trends. But here's where the story gets really interesting. Because what we're witnessing isn't just smart investing. It's positioning for what could be the most significant wealth transfer in precious metals history. And the signs are everywhere if you know how to read them. Look at what's happening in the derivatives market right now. The ratio between paper-silver contracts and actual physical metal available for delivery has reached levels that should terrify anyone holding paper promises. We're talking about hundreds of ounces of paper-silver claims for every single ounce of deliverable metal sitting in exchange vaults. When I see numbers like that, I don't see a functioning market. I see a powder keg waiting for a spark. And JPMorgan appears to be positioned on the right side of that equation, holding actual metal while others hold contracts that might prove impossible to fulfill. The exchange data tells a story that most people aren't paying attention to. Registered silver inventories, the metal actually available for delivery against futures contracts, have been draining steadily. Meanwhile, eligible silver, which is just stored but not available for delivery, keeps growing. It's almost as if someone is systematically removing deliverable silver from the market while maintaining the illusion of abundant supply. This pattern should concern anyone who understands how commodity markets function. When physical availability becomes constrained while paper trading continues to expand, you create conditions for what traders call a squeeze. Prices don't rise gradually in these situations. They gap higher violently as market participants scramble to secure actual metal. JPMorgan's strategy becomes even more brilliant when you consider the timing of recent market events. Exchange outages, settlement issues, and unusual trading patterns have become increasingly common in precious metals markets. Each incident reveals the fragility of systems that have operated smoothly for decades. During one recent exchange outage lasting over 10 hours, silver prices spiked to levels not seen in years. When trading resumed, bid-ask spreads were so wide they suggested complete market dysfunction. This wasn't normal volatility. This was what happens when paper markets lose their ability to control physical prices. The response from major players like JPMorgan was telling. Rather than increasing available supply to stabilize markets, they actually reduced the amount of silver available for delivery. They reclassified millions of ounces from registered to eligible status, effectively removing them from the pool of metal that could be delivered against contracts. Think about that timing. Peak physical demand, system stress, and reduced available inventory. That's not coincidence. That's strategic positioning by institutions that understand what's coming next. The lease rate data supports this theory perfectly. When silver lease rates hit 30% annualized, it means market participants were desperate enough for physical metal to pay extraordinary borrowing costs. That's not normal market behavior. That's what shortage formation looks like in real time. Meanwhile, industrial users are starting to panic. Solar manufacturers, electronics companies, and automotive producers are all competing for limited silver supplies. Unlike financial speculators who can simply close positions and walk away, these companies need actual metal to maintain production. They'll pay whatever price is necessary to secure supply. This creates what economists call inelastic demand. When price increases don't reduce consumption because the commodity is essential, you get explosive price movements that can continue far longer than anyone expects. JPMorgan appears to be positioned perfectly for exactly this scenario. The historical precedents are sobering. Every time physical commodity markets have faced genuine shortages while paper markets maintained artificial pricing, the eventual corrections have been spectacular. We've seen it with oil, agricultural commodities, and other industrial metals. Silver appears to be setting up for a similar event. What makes this situation unique is the scale of potential disruption. Silver markets are relatively small compared to other commodities, meaning even modest shifts in supply or demand can create dramatic price movements. When you combine structural deficits with institutional accumulation and growing industrial needs, you create conditions for extraordinary volatility. The currency backdrop makes everything more volatile. When central banks expand money supplies aggressively, investors naturally seek alternatives that can't be printed or created electronically. Precious metals have served this function for millennia, but silver offers advantages that gold simply can't match. Silver's industrial applications create dual demand that gold doesn't face. While gold serves primarily as a store of value, silver must satisfy both monetary and industrial needs from the same limited supply. This creates potential for much more dramatic price appreciation when market dynamics shift. JPMorgan's accumulation strategy appears designed to capitalize on exactly these dynamics. By controlling significant physical supply while demand from multiple sources continues growing, they've positioned themselves to benefit regardless of which catalyst ultimately triggers the next major move. The mathematics are becoming undeniable. Current consumption exceeds mine production by substantial margins. Above-ground inventories continue declining. Industrial demand keeps accelerating. Meanwhile, paper markets trade as if unlimited supply will always be available at current prices. Something has to give. And when it does, JPMorgan will be holding the assets everyone suddenly needs. That's not speculation. That's strategic positioning based on fundamental supply and demand imbalances that can't be resolved through financial engineering. The next phase of this story is already beginning to unfold. Exchange inventories keep draining. Industrial users keep competing for supply. Paper markets keep expanding claims against shrinking physical metal pools. Each day brings us closer to the moment when these contradictions can no longer be maintained. When history looks back at this moment, JPMorgan's decade-long silver accumulation will likely be remembered as one of the most prescient institutional strategies ever executed. They saw what others missed, they understood what others ignored, and they positioned accordingly while the window of opportunity remained open. The convergence we're witnessing isn't theoretical anymore. Industrial demand surging, mine production stagnating, inventories draining, paper markets stressed, and the world's most sophisticated banks sitting on massive physical holdings. These aren't coincidences. They're the ingredients of a transformation that could reshape precious metals markets permanently. Whether silver reaches the dramatic price levels some analysts project, whether the timeline unfolds as anticipated, whether the systems hold together longer than fundamentals suggest they should, these questions will be answered soon enough. What's already clear is that JPMorgan positioned for scenarios that most market participants haven't even considered. The opportunity to understand these dynamics, to study the patterns, to prepare for what might unfold, that window is still open. But like all windows in financial markets, it won't stay open indefinitely. The smart money has already made their moves. The question remaining is whether you'll recognize what's happening before everyone else does. History has a way of rewarding those who see clearly while punishing those who ignore obvious warning signs. Right now, the signs are everywhere. The only question is whether you're watching.